and not only dividend income, but dividend growth stocks. We're going to talk about taxes. So this is one of my favorite topics when it comes to planning for retirement income. So we have with us, we have Chris Perras, CFA. We have Charles Scavone with us, also a CFA. Both of these gentlemen are responsible for managing well over $100 billion over the course of their career. Both Chris and Charles, had to turn the mute off there. So both Chris and Charles are responsible for managing four-star Morningstar funds, 5-star funds, as well as both Lipper ranked #1 and also #2 ranked funds. So we have a heavyweight team here as part of the Oak Harvest investment team to really discuss in detail dividend stocks. We're going to compare individual securities to index funds. We got a lot of good questions submitted in regards to that. Going to talk about dividend stocks in relation to growth stocks and the type of economic environment each one performs better in. And I'm going to, as a certified financial planner professional, really discuss the tax planning component of how do we not only generate income in retirement with dividend stocks, dividend growth stocks, but then also let's keep a focus on after-tax return, after-tax income. So I'm really excited for that because we're going to explain how to have 0% taxes on those dividends. And no, we're not talking about inside a Roth IRA, which someone did submit a question about that. So a lot of ways to take advantage of the tax code, which pours over into Social Security taxation and also Roth conversions. All of these different pieces of the pie work together in retirement. So I'm really excited about this. When we started planning, I'd say about a month ago, what's the topic? Chris, you know, for years it's been dividend stocks is something that I'm kind of near and dear to my heart. So I want to start with dividend stocks versus growth stocks because I think laying the foundation here of the differences between dividend stocks and growth stocks, but also the economic environments that dividend stocks typically perform better in compared to growth stocks. So talk a little bit, please, Chris, about just the difference between dividend stocks, stocks that have a long history of paying dividends, and companies that decide to allocate their capital to investing in projects as opposed to returning that cash to shareholders in the form of a dividend, better known as growth stocks.
Yeah, thanks, Troy. So, I mean, for the better part of, 5-6 decades, up until around 2010, thereabouts, dividend growth stocks, those companies that pay a dividend and then increase their dividend every year, if you invested in those companies and reinvested the dividends, those stocks had a history of outperforming the S&P 500. They compounded your money over time by allocating your capital very wisely. You fast forward to the great financial crisis in 2009, 2010, and what happened is the Federal Reserve dramatically cut interest rates, and for the better part of 10, 12 years, all you saw as far as stocks outperforming the S&P 500 were growth stocks, stocks that paid little to no dividends, the FANG stocks that almost everyone is aware of, that are taking your capital as a shareholder, and instead of investing in a project that is near term, they're investing in something that's longer term, that doesn't have a defined time frame of payback. So they're not going to pay you a dividend because that return on their investment, it might be 10, 15, 20 years out. So they don't have the luxury of taking some of that cash and handing it back to you and compounding. So, we had that long period from 2009 through pretty much December of 2021 where it was FANG stocks outperforming. And then the last 15 months, we've gone back to an environment where dividend stocks have kind of come back in vogue, particularly during the first 9 months of 2022 when the Fed was raising rates really aggressively. And if you looked at the S&P 500, growth stocks dramatically underperformed the S&P 500, and then dividend stocks, they tended to outperform. Some of them were up. Most of them were, flat to down some, but outperforming the S&P 500.
So a growth stock is something like Google, something like Nvidia, Amazon, even though really, when you look at those companies right now, they're so big as far as market capitalization at trillions of dollars. It's how much bigger can they really grow? I always kind of think about. And then your dividend stocks, you're thinking companies that are much more mature in their history and also their much more resilient when it comes to recessions because they have a business model where their revenue, think Pepsi, for example. Pepsi is going to sell Frito-Lay and soda drinks no matter what the economy is doing. So companies that are a bit more boring, and in times of economic uncertainty, those boring companies that have recurring revenues, they tend to typically do better. So to kind of sum up what you just went through, once the Fed lowered rates coming out of the financial crisis of '08, companies could borrow money, growth companies, at basically zero, then be very aggressive with the various amount of projects that they decided to undertake. And from a CFO standpoint, it didn't take a lot of profitability in those individual projects to justify borrowing the money because there wasn't a very high required rate of return. If I'm borrowing money at zero and I end up doing a project that only returns 4 or 5%, well, that's still making money. But if I do enough of those projects, some are going to return 1,000%, 2,000%. So those growth stocks, they became a bit excessive with the money they were borrowing, but that's why we invest, is for growth. They're trying to hit some home runs. And then, of course, your dividend stocks not going to perform as well in that environment. So Charles, over the course of your career, investing in growth stocks and dividend stocks, what are some of the highlights that you've seen over the years? What are some of the things that you watching at home should understand the difference between growth stocks and dividend stocks, and just the economic environment in general? Which ones kind of perform better?
Yeah, well, I think you guys have both done a really good job of sort of framing up what it is we're talking about and how it becomes, at the company level, at the executive level, it's a capital allocation decision. And if you're in a high growth phase of the company, right, you need that cash flow to generate, buy that next, either, invest in that next project, that next tool, and so forth. And the way that we would look at it is we're always primarily growth investors, but certain companies had very defensible business models, and that afforded them the luxury to be able to not only grow the business, but also have excess cash that they would pass on in the form of dividends to shareholders. So it's searching through and finding the right type of company, the right profile, the right defensible type of business model. What it lends itself and where it leads a lot of times to is the fact that many of these firms are classified more as value stocks than they are as growth stocks, and that is just as a result of the nature of this defensible business model that allows them to generate cash flow, not completely regardless, but almost regardless of economic condition and the decision that they've made to pass some of that on to shareholders. So it serves a very useful place within somebody's entirety of their portfolio, because there are a lot of interesting attributes that you can create in terms of the return profile of a dividend stock, and then obviously a portfolio of dividend stocks. And so it tends to be less volatile. You have this additional income stream that you get paid. If you're waiting for great performance or something from a particular company, one of the things we would always say is if it also paid a dividend, you kind of get paid to wait. You roll that up into a fund, you're getting paid while you may be sitting there in an idle market, in a market that's not very active. If the market's tremendously volatile, you've got this buffer of an income stream to help reduce some of that volatility. And then if it's a down market, you probably do better than the overall market. But if it's a strongly rising, upward trajectory market, you probably lag a little bit.
And right now we're lumping dividend stocks into one broad category, and really there's kind of two types of dividend stocks that we talk about as a group. There's dividend high yielders, which may have a 6 to 10% dividend, and they're not increasing their dividend. And then there might be the 2 to 4% yielder that is increasing their dividend every year and growing their business at the same time. As a team, we try to stay away from those high yielding stocks that are 6 to 10%, because those are typically unsustainable. We've seen just in the last couple months, actually today I think Intel cut their dividend. It was yielding 5.5%, and they had to cut their dividend back to the level it was like 16 years ago.
Right.
Meanwhile, their stock also has gone down 50% in the last year. So, that 5.5% dividend that you were getting the last couple of years didn't do you much good because you just lost 50% of your money the last year. So there's, we have tons of examples.
So the optics of it look really good because it's this high yield, and that's great. You accrue, this slightly higher yield for, over the course of several years, and then one day happens and boom, it's gone. And so for us, it's really important to make sure that the company not only has the willingness to do it, but the wherewithal to do it. And we spend a whole lot of time internally looking at the companies that we choose to put in this type of model, just for that reason.
And those high yielders are even worse than they look a lot of times because they're paying you. If it's in a taxable account, you're getting paid a dividend in a taxable account, and you're having to pay taxes on that dividend. And then your stock's going down, so all you're going to get is a tax loss carry forward when you sell the stock, which isn't, the best thing in the world. You don't invest in something for a tax loss.
So I want to come back to this because what we're really talking about here is the ability to have visibility in regard to the individual financial metrics of each company that is paying a dividend. And this is going to tie into the individual stock versus the index fund discussion, which I'm really looking forward to get into because there are pros and cons, of course, for both. And I want to come back to just how we set up the trade desk, let's call it, and the importance of having the visibility across all the different metrics that go into how likely is a company to continue to pay that dividend over time. But before we do that, I want to take just a brief step back here, and I want to explain what a dividend is, because I know we have people watching that may be very familiar with dividend stocks, but also based on some of the questions that were pre-submitted, we may have some people that, hey, maybe not 100% certain on what a dividend is, but also even throughout the course of my career, even some of the more sophisticated investors, there's a couple basic points that seem to often kind of get overlooked, and I want to clarify these. So when you think about dividends, please, I want you to think about cash distributions from a company. Now, don't think about yield, don't think about it in terms of percent, because that is nothing more than a calculation based on the dollar amount of dividend that you actually receive and the current fair market value of that stock price. So don't think about dividends in terms of yield. This will go a long ways towards helping you become a better dividend investor. When you think about where do dividends come from? Okay, they don't come from earnings necessarily, although the common ratio that people look at to determine how likely a dividend is to be paid is what we call the dividend payout ratio, and it's simply looking at earnings and then the cash dividends paid. One of the better places to look is what we call free cash flow, because dividends come from cash. And here in Houston, ExxonMobil is a great example where for many years, I don't know the exact number, but the past 4, 5, 6 years before oil really spiked in price, Exxon was borrowing money to be able to continue to pay that dividend because they didn't have the cash flow. So now normally from an investment analyst standpoint, if we see a company that's paying a 4, 5, 6, and oftentimes this will happen at a 7, 8, 9, 10% yield, and this is what you guys are getting at. Yeah. If you're simply looking at earnings based on the dividend payout ratio, or the dividend payout ratio based on earnings, well, you oftentimes can overlook critical elements that are important to determining how viable that continued cash dividend is, because earnings can be manipulated through such non-cash items like depreciation, for example. And there's other items that obviously go into earnings that cannot be as easily manipulated when it comes to cash flow of a company. So one thing I want to focus on here is cash flow. When you think of dividends, think of cash flow, because that is where dividends come from and that's what you actually receive. Now, if a company is paying a 5% dividend, just to make this math easy, and the stock price is trading at 100, okay? So 5% of 100 is $5. If you can think about that as $5 as opposed to 5%, this really helps to understand dividend stocks in the whole. Now, if that company drops in value from $100 per share to $50 per share, they're still, in this example, paying you a $5 dividend, but now all of a sudden that's a 10% yield. 5% of 50 is 10%. So what I've seen throughout my career when people come in and talk to us for the first time is, Troy, I like to invest in these companies that pay 8%, 9%, 10% dividends, but a lot of times, whether they're doing a stock screen or they get something recommendation from a buddy on the golf course, they're looking at it, it's paying a 10% yield, but what they're not seeing is the stock just lost 50% of its value over the past year, and that's why it's a 10% yield. So what type of danger when people invest in dividend stocks that have these high yields do they face? But also, more importantly, if we were to compare that to, let's say, a company that's healthy, that has tremendous amounts of cash flow, that are increasing margins, increasing revenue, increasing profits, that's maybe paying a 3% or 3.5% or a 4% yield. So would you rather have talk about those two investors right there. One has a 10% yield investing in companies that maybe aren't so financially healthy, right, versus someone that 3 or 4%, but they're investing in a company that's making gobs of money just hand over fist.
I'm all about having a greater degree of confidence in what's going to happen or what I see playing out. So I'm all for, although the absolute dividend yield may be slightly lower, if I'm growing that dividend and can do that in a sustainable way, that's where you want to be, right? Otherwise, you're just going to run into that wall. It's like the example you're saying is just sort of like running into that wall. You're eventually going to hit it one day. We used to refer to that strategy of just picking just the high dividend yielders is, absent anything else, is picking up pennies in front of a steamroller, right? It seems really easy, and it's like I'm just picking them up.
It's free money.
But you make one mistake and you're dead, right? So it's the same sort of thing. So I'd much rather have a higher degree of confidence in what's to come with the company's ability.
Because, and a lot of that comes from because the nature of a dividend is it is not a contractual obligation of the company to pay you that money. Mm-hmm. It's not like a bond. When you own a bond, you're in a contract with the company that they borrowed money from you. They pay you interest if they default on it. There's ramifications. With a dividend, there is no contract between you and the company. The company, like Intel, just 2 days ago or last night, or AT&T a couple months ago, they can come in and talk to their board of directors and say, "Hey, we don't have the cash. We're cutting the dividend 75% at any time." Yeah. So, and as a shareholder, there's nothing you can do.
Yeah. So, but there are dividend stocks are tremendously valuable. Yeah. But I think the point that we're making here is, when we allocate capital, if you're in retirement or entering retirement, the decisions that you're making about the investment portfolio are critical, more critical than any financial decision you've probably ever made. When we start to chase yield, look for companies that are paying high dividends, then oftentimes we can kind of find ourselves possibly in front of that steamroller. So, okay, I wanted to make that point between high dividend paying stocks and more traditional dividend paying stocks. And one of the things I wanted to get to there is the capital appreciation potential, because when we look at total return of an investment portfolio over time, there are two components. We have the income component, which comes from dividend, but then we have the capital appreciation component. So when we enter in retirement, diversification, tremendously important. Having multiple streams of income from multiple places, very important. But we do not want to sacrifice capital appreciation potential for simply high yield, because history has shown us time and time and time again that that's not the most efficient way to allocate capital. So what is the dividend growth stock versus a dividend stock? Very I think a distinct conversation here, or at least a distinct difference that needs to be made, because we opened the conversation with growth stocks. Mm-hmm. And now I'm talking about dividend growth stocks. So some of you may be thinking, is a dividend growth stock just something that pays a dividend but also grows? No. So a dividend growth stock is a company that has a long history of not only paying you that dividend every single year, but increasing that dividend payment. So the example I gave prior, if you get a $5 dividend and the stock is based at 100, if the company has a long history of increasing that dividend payment to you, on average, let's say 5% a year, that means last year you got $5. This year, that dividend payment, you would expect, it's not guaranteed, but to increase about 5%. So now you're receiving $5.25 per share. But then the next year comes, and let's say they increased it another 5%. So now you're getting $5.52 or $5.53, because there's a compounding effect there. And this is what we call, It's what's called a dividend growth stock. And there are companies out there that have not only paid their dividend, but increased the dividend every single year for 5 years, 10 years, 15, 20, 25 years. Once you get to that 25-year status, you're known as what's called a dividend aristocrat. And Exxon is a dividend aristocrat, and that's why they were borrowing money, is because once you hit that prestigious status of having increased your dividend every single year for 25 years, if you miss one payment and you don't increase it, you lose that status, and it takes another 25 years to build it up.
And you get kicked out of certain indices, certain, triggers points for certain types of investors, and so it's generally viewed as bad.
Yep. So dividend growth stock is not a dividend stock or stock that pays a dividend, and the price of the stock is expected to grow. It's a company that actually has a long history of not just paying that dividend, but paying an increasing amount of dividend. And I tell you what, in periods of high inflation like we're going through now, and a lot of you are wondering, how do I keep up with inflation? What's one of the ways to combat the ever increasing prices that we're seeing at the grocery store and other places? Well, I know for our clients, and I know for myself personally, that when I have a conversation with a client and I remind them about, hey, not only do we have dividends coming into this portfolio in a down market, some of them are reinvesting, of course, and we're accumulating more shares, which means more dividends and possibly more income, but also the growth of those dividends, we're getting increasing dividends. So again, dividend growth isn't guaranteed. Dividends themselves are not guaranteed. It's a slice of an overall plan, but I know from my experience in talking with thousands of clients over the years that that's a very comforting feeling when they know that, hey, not only am I receiving income from my principal, but you're telling me, Troy, that I have a reasonable amount, to a reasonable degree, I can expect that income to increase moving forward if these companies continue to have these dividend payouts.
And what that takes is a thoughtful process of selecting those stocks and spending some time in making sure you do your work and not just mapping some index.
Which is a perfect segue into the next discussion about individual stocks versus index funds. But we have a raffle right now. So for those of you who saw this, some of you did not, if you pre-submitted a question, if you registered for the raffle, what we're doing right now is we're going to, on the back here, we have Heather, who is going to pull a random number, your name, if you've registered for this webinar, if you've signed up for the raffle, or submitted a question, you're in this raffle. So we're going to give a $50 gift certificate to your favorite restaurant. What we're going to do is call you if you win, and then Heather is going to help coordinate that with you. So we are going to do this raffle now. We're going to do one more at the end of this. This whole program should last about an hour. Sometimes we really get into the Q&A and some of the questions and feedback, which I've been so honestly into this conversation, I haven't even looked over here at any of the questions, guys, so I do apologize.
We'll stay late if we need to.
So, Match Point, keep hanging in there. I do see that. Match Point says he's a novice investor. A little bit overwhelming, but good information. Well, why is that? When dividends are paid, the stock price goes down proportionately. That's a simple question. It's a return of capital. That capital is no longer in the company's bank account. It's accounted for in the market value of that stock, which is actually a very, very good point that people don't look at. So, okay, we have Brennan back here.
And the first one is James Baker.
James Baker. Okay. Mr. Baker, you are the winner of our first raffle. So Heather is going to reach out to you. She is going to get the name of your favorite restaurant, and we will coordinate getting that gift certificate out to you. So you're welcome, Match Point. He says thank you. So a lot of questions here, guys. I apologize for not paying attention over here. So I tell you what, Charles, why I go through some of these questions and formulate some responses and some talking points here. You were getting into the discussion about having, and ties back into what we said before, the visibility to understand the metrics, paying attention to cash flow, which companies are likely to continue to pay that dividend, but also possibly continue to increase that dividend payment versus an index fund. In that conversation.
Yeah. So it's been, very, very common, and it's been just fine for the last, 10 years or so, passive investing, indexing, everybody's selling low cost. And so the emergence then of index funds and low cost ETFs that match these index funds proliferate. They all do well. The environment is such that they're in a position where they will do well. Okay, but look and see. I always say, you know, let's take a look at how the sausage is made. You go and look and see, there is an index that's created to track a certain sector of the market, and then a firm will latch onto that and say, okay, well, I can build this product, incredibly low cost, no services, nothing, just as plain vanilla as you can be, and it's going to take every dollar that you, the investor, gives them, and it's going to allocate it based upon a computer model that's based upon this particular weighting within an index, and it's going to give it to those companies or invest in those companies regardless of the investment merit at any particular point in time. And so we take the other approach. We say, you know what? And so what you end up with, to back up, what you end up with in a lot of time are these firms. They have a high dividend yield. They look very attractive. They're part of an index. Keep allocating money to them, and then boom, right? They blow up, cut the dividend. You, the investor, you know, suffers the result. It's so much more effective, I believe, to spend the time, make the effort, understand, have a good process that we use to identify these stocks based upon a lot of the financial criteria that Troy was talking about, that we think have both the willingness and the wherewithal to pay that dividend, continue to pay it out at an increasing rate, build our funds in a manner that allows us to express a view. And that's why you pay an advisor or you pay an active manager the fee you do. At the end of the day, I think we're going to come to the realization that in most cases you do get what you pay for. And I think we're seeing that now.
Yeah, people who've watched these know that I like examples, concrete examples. And Charles is talking about indexes. We've been doing a lot of work the last month since Charles came on board in looking at our portfolios and looking at the dividend components and the dividend growth components and looking at the indexes that track some of these dividend aristocrat ETFs and mutual funds that are out there. And lo and behold, we saw, I think it was like 2 weeks ago, the number one holding in most of these indexes, I think, was VF Corp, which is an apparel manufacturer, essentially. I think it was yielding 4.5%, or maybe that was the weight in the index. They cut their dividend after 20-something years of raising it, and the stock, cratered. So, as Troy was talking about, we're looking for dividend growth companies and sustainability. An example here I have to go back to is, if most people here know Intel, and most people know Texas Instruments. We live in Texas, both have large operations here. And if you look back over the history of Intel since the peak of the internet bubble, so take it January of 2000, Intel stock is down, the stock price change is down 41%, okay? You add the dividends into that, and you get Intel stock is zero. Okay, it's got a zero total return since the year 2000. Okay, you compare that against Texas Instruments, whose price return, price appreciation in capital, was 227%. Okay, but the total return was 390%. The difference between the 390% total return and the 227% capital appreciation is that dividend that they're giving you on a quarterly basis, and they're compounding. And if you're an investor, if you're reinvesting it along with them, it's something that compounds over time. So, it's the stock picking that allows you to differentiate, regardless of how many times the CEO on Intel is on TV talking about how good business is, or how the Inflation Reduction Act is going to give him $25 billion. He basically is spending more money on plants than he's taking in, and the stock knows that, right? The stock went down 50% the last year. And he was on TV almost every month.
Yeah.
So.
And I think more importantly, Charles, and Jay, I don't know how to correctly pronounce your name, but last name Desai. I'm gonna thanks for posting that question. We're gonna address it because it segues into the tax discussion that I want to have, but also it's a very, very good point that everyone can benefit from. So the thing to understand there, I think, is when it comes to index funds and it comes to individual stocks, when we're talking about customizing a retirement plan for the people who decide to work with us, I feel we have a bit more flexibility when it comes to how much income do you need? What is the capital appreciation goals? What are we trying to accomplish here? And we can buy an index fund for 30 or 40 basis points, and we were talking about a couple of these beforehand. There's actually, I think, some of the better index funds available now than probably any time in history. So there are some good options out there. It's not that we're saying that those are bad options. It's just, one, you kind of get what you pay for. And is it more of a customized approach that's including your investment plan with your income plan, with your tax plan, and of course with the estate plan? How are all those different pieces working together? And JEPI, for example, we saw this one earlier. It's a fund, we talked about it, a lot of questions about this one. It's a fund from JP Morgan, 20 billion in assets. Probably the wrong time to bring this one up, only because I want to get into the taxes and bring up Jay's question, but I want to come back and talk about this specifically. But it's about 11% yield. It's only been in existence for less than 2 years. But the complexity, the exotic nature of how they're generating that 11% yield is, one, it's not likely to continue at that yield point. And then what happens? There's a mass exodus from the fund, massive selling pressure. The people who don't quite understand or who are out in the golf course or hunting or fishing, they're the ones left holding the bag. The stock's down 20%. The dividend's now 4 or 5. But it doesn't mean that these index funds or JEPI, for example, it doesn't mean that they maybe don't belong as a slice or a sliver of an overall portfolio, but we need to have a specific plan. Okay, who are you? What's important to you? How much income are you trying to generate? What type of capital appreciation is the target to achieve those goals over a 20 or 30-year period? What's the tax consequence? So JEPI, for example, about 80% of that dividend is income taxable. We're not getting the qualified dividend preferential tax rates there. So it's what we would call the equivalent yield when you take taxes into consideration is actually much less, not to mention the variability over the next 5 to 6 years of what that will actually be. So I kind of went a few different ways there, but I think the important thing is it's about customization. And for some people, that is the right way to go. You know, keep investing in those index funds, but make sure you pay attention, make sure you know what's going on. But for those that actually want to know, hey, how is my income tying into my taxes? What is my risk level? What type of actual potential capital appreciation do I need to accomplish these goals? How do I bring all this together? And I think if you choose to work with a financial advisor because those things are important to you, then that's what pushes you over the edge to pay that extra 60, 70, 80 basis points, whatever that is, because you feel you're getting value on the tax planning, the estate planning, all those things that come together. Okay, so Jay says, and I want to talk about this, guys, because one, it's a financial planning question. It ties into the taxes, but also it's diversification. So not all of the comment came through, Jay. So, and I'm going to keep it high level just to begin with, but he has J&J, and he works for J&J because it's company stock, and he's asking about the net unrealized appreciation discussion. So it's funny you bring this up. So we do advisor training multiple times kind of throughout the week here. In the past couple of weeks, we've been focused on net unrealized appreciation. So the short version, and we just have a YouTube video. Eric, when's that coming out, the NUA one? A week or two? We have a video coming out on this, Jay. You're going to have to pay attention to it. And everyone else who has company stock. So I get excited about these things. It's just exciting to me. Okay, so he's got 1.7 million in J&J, and he's I can't find it here, but he says, hey, it's a good dividend. It's highly rated. I'm not quite sure who's rating the dividend. Maybe Zacks or something along those lines. But $1.13 per share, so for $4.52, he's at $4.52 a quarter. Long story short, what he's saying is, hey, should I roll this out and diversify my J&J about 1.7 But it's a good company. It's a highly rated company, and I'm getting a good dividend. I could live off the Jay. I know what you're thinking. I could live off that dividend. I won't touch my principal. So this kind of, I'm going to come to the tax side after this, but guys, I'm going to throw this over to you. In general here, what's your opinion? And we're not, let me just preface this by saying, Jay, we can't give you personal financial advice. We can only talk in general about diversification versus a concentrated equity position in a portfolio. But we've seen this a lot living in Houston, where Exxon stock, Chevron stock, I mean, you name it.
We saw it here in Houston in energy stocks. I lived in California during the internet bubble, so I saw it in tech stocks. We are a big, J&J is a favorite stock of ours. We hold it in a number of portfolios. At the same time, I don't know your entire financial situation. And if you are retired and you used to work for J&J, and that is 60, 70, 80% of your net worth, not even knowing you need to diversify it, right? Because the problem becomes is we become emotionally attached to these companies. And it's not that J&J is not a great company. It provided you a career. It provided your family, probably house and kids, college and everything else. And we become emotionally attached to that. But, you don't have any control over what J&J is doing, particularly when you don't work there. You don't have control over the talc litigation as far as, cancer and whether that goes through. And, if you wake up one day and there's some massive lawsuit because of opium, drugs that somehow get, laced back to J&J, you just don't know. So if you're no longer working for them, or even if you are, you should be diversifying, because if you're working for them, you're getting your salary, you're getting additional stock usually every year, and then you have this big lump sum that's also in J&J. So you're leveraged 3 different ways to J&J. So I would say you need to diversify whether you're still with J&J or whether you're not.
And there's a bias that plays in here too. It's an overconfidence bias.
Yes.
And I'm not saying you're overconfident. What I'm saying is the psychological term for this is overconfidence bias, where and also what we call the illusion of control, where we feel that, okay, we know this company very, very well, so we have some control of the outcome because we know the company. We feel good about the company. But also we're a little bit overconfident there, in the sense that, we believe in it so much that our retirement is going to be okay. At this stage of the game, it's about managing risk. Yeah. And it's not only about managing risk, it's about optimizing taxes. So you have an amazing opportunity, depending on the cost basis of those shares, to take advantage of the tax planning that the NUA offers you. Now, there needs to be an analysis. You need to talk to someone who truly understands this. But if you can tie in the net unrealized appreciation potential, you pay income tax on the basis when you roll that out, then you can pay long-term capital gains on what we call the net unrealized appreciation. When you really do the analysis and tie that into a bigger plan, and then guys, offhand what the J&J yield is right now?
I don't.
3-4% maybe, somewhere in that range. That's probably a bit high.
I think that's a bit high, but and they're going to do a spin-off of some of their subsidiaries at some point in time here. So let's say it's a 2.5% yield. Would we rather have the same amount of income coming from that portfolio in a more tax-advantaged structure, but then the risk is reduced by 60, 70, 80%? Here's something that I'll often use with people. Let's say we have 2 investments, investment A, investment B. So investment A returned 10%, investment B returned 10%. In this example, investment A is J&J for you. But they both returned 10%. Which one would you rather have? So a lot of times when I ask a client this, they'll kind of look at me and say, Troy, did you mean to write a different number on the board there? I said, no, it's both of these did 10%. Which one do you want? And they say they're the same. Well, no, because with investment A, when we look at the risk, when we kind of lift the curtain and look behind the scenes, investment A came with risk of potentially losing 80% of all of the money that you had invested. But investment B had the risk of only losing 15%, the maximum downside or expected downside. So now if I pose that question to you, would you rather have investment A or investment B that both return 10%? Which one do you want? Every single one of you watching wants investment B,
Okay, so that's the decision that faces you. It's not, hey, J&J is highly rated. I work at this company. I know this company. The simple fact is you have investment A right now, and I'm not specifically laying out the characteristics of J&J stock. I'm just saying if something bad happens, okay, yeah, you have an investment that could lose 80% of its value. Okay, and then you're working for another 20 years. That could happen. That is not out of the realm of possibility. Mm-hmm. Now, the bias starts to come in, and you may be sitting at your laptop or in your living room watching on television saying, Troy, that won't happen. That won't happen because I know this company. Okay, that's the bias, right? So good conversation, but I want to kind of segue that. Charles, well, real quick, before I do the taxes, we're going to get into the 0% taxation of dividends. I just want to give Charles an opportunity to speak on that because we covered a whole lot right there.
On the dividend, on J&J and the dividend?
Well, just in general, just
I'm
concentration risk.
I think you did a great job of describing it. People don't understand there's certain biases that we all have. They're behavioral in nature, and they cause us sometimes to lose sight as to what we're doing, and that's why it's a good idea to come and talk to somebody that can put it in front of you and explain what your potential outcomes are, because as individuals, we don't always look at that. Same thing happens when we're looking at building individual model portfolios. People always come up and say, well, Charles, what's your favorite stock? I'm like, I don't have a favorite stock. So I'm looking for a particular set of characteristics that I think are durable and sustainable, and making a decision how much I'm willing to pay for it. If I become too emotionally attached to something, that's going to be a problem. It's the same parallel what you just described. So for me, from my previous answer, you would know that, I'm all about having a higher degree of certainty. I'd rather know with nothing certain, but having a higher degree of certainty means a lot.
Yeah. So, okay, Eric, I'm going to go ahead and I want to switch over to the computer screen here because I want to show some of these tax scenarios. So while Eric is getting that switched up, it looks like he's already done. Okay, so most people don't realize what the income tax scenario is. So when we look at the U.S. tax system, we have essentially, when it comes to dividend and capital gains and income taxes, they're two completely different calculations. They go onto one tax return, and both of the amounts of those go into what we call adjusted gross income. So you have gross income, your Social Security, your wages, or your IRA distributions, your dividends, your capital gains, all those go into gross income on your tax return. But when it comes to actually calculating the tax you owe, there's two different tax systems there. And there's an ordering or a sequence of how different income that you generate gets taxed. And I'm going to show you this in very, very simple terms right now. So I have my handy dandy chart here. In 2023, if you're a married couple and you have taxable income of $89,250. So what is taxable income? All of your income goes to what we call gross income. Then you have what's known as above the line deductions. Think your 401k or your IRA contribution. If you're self-employed, your health insurance. You have a number of what we call above the line deductions, and that brings you down to what we call adjusted gross income. Now, from your adjusted gross income, or AGI, this is a very important number because so many things in retirement and tax planning in general are tied to this number. Okay, there's also something called modified adjusted gross income where we add things back in, such as tax-free muni bond interest, but not going to go there. From your adjusted gross income, you then subtract your standard deduction. You subtract that standard deduction, and now you're at your taxable income. This is the $89,000 level that if after that math, you come in below on a taxable income, if you're married filing jointly for 2023, $89,250, your long-term capital gains and your dividends are 100% tax-free. But if you're single, that drops down to $44,625. Okay, so it's essentially it's a cut in half, which brings me to a little bit deeper, more advanced retirement planning conversation, which just I want you to be aware of it. Not going to go down this rabbit hole, but when we're income planning and tax planning over the 10, 20, 30 years of retirement, when one spouse predeceases the other, you drop from that married filing jointly bracket to the single bracket, and without proper tax planning, it gets bad because all of a sudden you have less income, 10, 20% less a lot of times, but your taxes go up 10 to 20%. It's a major oversight, in my opinion. Maybe not an oversight, maybe it's done intentionally, but it's just, I don't want to get into the, I don't want to, it's not for me to say. Point is, it's...
Hold the chart up on your computer.
No, I do not. But thank you, Eric. I do not have it on the computer. But I do have these sheets where I'm going to go through the dividend taxation, long-term capital gains. This is really, 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 really important. Okay, so Eric, I'm going to go ahead and pull it up now. Okay, so this first one, I take it they can see my screen? Okay, guys, so what I want you to see here is this is total income. You see this $120,000? I'm kind of scrolling my mouse over it here. Look at the total tax here, $458. So if I were to tell you before I showed you this that you could have $120,000 of income and pay $458 in taxes, would you believe me? No one watching probably would. But here's where the income comes from. It is about $20,000 of dividends. You see over here where I'm scrolling my mouse, and $100,000 of long-term capital gains. So because of the Trump tax cuts, where they increased the brackets and lowered the rates to a certain extent, we have created this environment where you can have massive opportunity for tax planning. Most of you who follow my YouTube channel and see the planning that we do, we talk mostly about Roth conversions because there's such a domino effect that happens from Roth conversions to Social Security to this exactly right here. I just don't get into the immense detail in every video because I could do these for 2 or 3 hours and then, it's not the right way to do YouTube. So, okay, $120,000 of income, all from long-term capital gains and dividends, qualified dividends, $458 in taxes. Now, coming to this next PDF that I have, this was something that we used for the advisor training I'd say about a month ago or so. $145,000 of income and $4,000 in taxes for an average rate right here of 2.9%. So my point here is that we have, well, first we have 20,000 of dividends again, but I increased the long-term capital gains to 125. One last thing I want to go through. I've included on this last one 165,000 of total income, but I've added a $20,000 IRA distribution. So the IRS has ordering rules. Whenever you have income, certain income fills up the tax brackets first. And I said to start this that we have 2 different tax systems. One is the capital gains and dividend tax system. The other is the ordinary income tax system. This is really, really interesting. So 165,000 of income here, total tax of $7,208. So the effective or average tax rate, average is a little bit different than the effective, but 4.4%. So if I were to tell you that you could have $165,000 of income and pay a tax rate of 4.4%, would you sign up for that? Yes. You're at home on the couch watching this, shaking your head, yes. So how do we do that? This is where tax planning comes in. We tie in the risk management plan, the investment strategy, the income strategy to the tax plan. Those are the first 3 steps of what we call the retirement success plan. Now, how do we get here? So this is $125,000 of long-term capital gains, $20,000 of dividends, but I also take a $20,000 distribution from the IRA. So I have it. Okay, so here's the 165 here. Okay, so this is what I wanted to show you here. So this is the 15%. You see this over here? This is the 15% dividend rate, long-term capital gain rate. So we can have up to $89,250 here, and it's everything below this is taxed at 0. But what happens is, because that's a separate tax system, when we take from the IRA, that fills up the income tax brackets first, and that full IRA distribution is taxed at 0% as well. But what happens is it brings in, think of it's like if you're driving a car and you're dragging something behind you. When you take money out of the IRA or have inefficient income from bonds or JEPI, for example, who it's taxed at ordinary income tax rates, you start to drag other sources of income into taxation. These 2 main sources are dividends, long-term capital gains, and Social Security. I guess that's 3. But we see here what we've done. It's probably confusing for a lot of you, but The overall point here is by taking that distribution from the IRA to get to 165, that was actually a tax-free distribution because that went into the ordinary income tax code or calculation. But what we did is we created more dividends and long-term capital gains to be subject to tax. So I hope I explained that clearly. But if not anything else, you see that here you could have if properly structured, you could have $100,000, $120,000, $150,000 of income and pay very little tax. Now, my objective here, because most of you have your money in these big tax-infested retirement accounts, and when you have that money in the retirement accounts, you have to come up with an exit strategy. So are we doing Roth conversions? Are we spending that money? When we're planning, we're not just looking at 1 year, we're looking at over multiple years. So for some of you, we might be able to do this for the first 4, 5, 6 years of retirement and defer the IRA distributions and taxation. For others, and this is most of you watching, we're going to do those Roth conversions to a certain extent to optimize the overall income and tax strategy. So once we get to whether it's 68 or 69 or 72, whatever that age is, now we're in this scenario where your Social Security is almost tax-free, if not 100% tax-free. Your long-term gains, your capital gains, all of that tax-free. So the thresholds again to kind of close out this section, because we got a lot of comments leading into this. It said, Troy, are you talking about dividends in a Roth IRA? No, this is your non-IRA money outside, $100,000, $125,000. Eric, if you're not on me, you can go back to me. This is your income here that if you have a tax plan and an income plan and you know where that money is coming from, there's a tremendous amount of opportunity and value to be provided from that. So those thresholds, again, if you're married filing jointly, taxable income of $89,250, and if you're single, $44,625. Okay, Heather, I think I heard the alarm go off there. We're going to do another raffle. So we're going to do a raffle. So if you're just tuning in, we're doing this every 20 to 30 minutes or so. We're giving away a $50 gift certificate to your favorite restaurant. If your name gets called, we are going to reach out to you, Heather. Quick story about Heather. I've known her since elementary school, I believe. We went to high school together. We went to college at Florida State together. She moved to Houston about a year or two before me. It's been almost 15 years ago. And Heather just started working with us last year. So she's in charge of event planning and marketing and coordinating all these things. Heather is going to reach out to you to plan this gift certificate. So Brandon, I guess that work in the gym hasn't been paying off, I see. All right, we're going to pass on the popper unless Brendan gets his forearm strength up.
Cut it open.
Jill Cooper. Okay, Jill Cooper, you are the winner. Brennan, you need to work a little harder in the gym. That's just not paying off. Jill Cooper.
Oh, now he's trying to surprise us. Good work.
So he took that personal, I see, and really put some oomph into it. I got the adrenaline going. Okay, so Jill Cooper, Heather is going to reach out to you, and we're going to get you that gift certificate. So congratulations for winning. Okay, guys, where do you want to kind of take it from here? I feel like we're on a roll, and I don't mind keep going.
Yeah, we answered a fair number of questions that were submitted prior. Is there anything else? Are we missing anybody's questions, maybe, you think? Or?
I've got a couple that
yeah, please, Chris.
Don't mind answering really quick. I was surprised. I mean, we probably had 3 to 5 people asking us about CDs and treasury bills and savings accounts, which I think that's probably a first in 5 years. And it's because short-term rates are finally yielding something. We had a lot of questions about CDs. I think people forget that a certificate of deposit is issued by a bank. So, the bank is you're lending your money back to a bank. So you are extending credit to a bank. So it should yield a little bit higher than probably what you would get by basically letting the government, the federal government, a treasury bill, letting them borrow from you. At the same time, there's more credit risk in it. So, unless we're talking large sums of money, the percent difference right now, probably between a 1-year treasury bill and a certificate of deposit at a bank, I can't imagine it's going to be that much different. No. It's, the mutual funds, the ETFs that we look at that are 1 year, 2 year in nature, they still have an interest rate that's underneath a 1-year or 2-year treasury bill or note, because there's so much demand that, like, if you look on CNBC, I think you'll see that a 1-year treasury bill is supposed to yield like 5.1%. The only way you will probably get that yield is if you go to Treasury Direct.
Yeah.
If you call up Charles Schwab, call up TD Ameritrade, you're most likely it's going to be like 0.5% less than that is what we found, because there's so much demand.
So, and also from a tax planning standpoint, CDs are taxable interest. You don't get the preferential capital gains rate. So what can happen with a lot of these, and this goes for bonds, this goes for JEPI, this goes for CDs. What happens is it's that dragging concept where we're generating interest, maybe a bit higher yield, but if we're making, let's say, 5% with a higher yield, if we don't have visibility on how that is creating other income to be taxed, we don't have a true understanding. Here's 101. It's not about the yield, it's about the after-tax yield. It's not about performance, it's about the after-tax performance. So we're not trying to increase a client's retirement income. What we're trying to do is to increase a client's after-tax retirement income. So these are the subtleties that when you understand planning, as well as investments, and you start to tie it together with a clear focus on a vision towards the future and what these objectives are, this is where we start really cooking, and things start really, magic starts happening in the sense that different pieces of that orchestra are working in concert with one another to create this beautiful sound that is the goals that you want being accomplished, the income, the taxes, etc. So we got a few questions. I see you want to ask something.
No, I'm just saying this. Troy just answered. So Rick Mayfield asked, why should a retired investor use a financial advisor as opposed to investing directly with Fidelity or Vanguard? And it's because, for the best of my knowledge, in my dealing with Vanguard and Fidelity, they are not providing the solutions that Troy is talking about on a tax-adjusted basis with regards to the totality. That's right. Yeah. Totality of your financial situation, right? They're going to be really good at looking at the investment side of it, but are they looking at Social Security or looking at Roth conversions? Are they looking at the Medicare? I can't even remember all the things that you have to deal with, but
they sort of provide single point solutions as opposed to more holistic.
Yeah, it's more of a
package.
Plug and play. And look, we have a lot of respect for Fidelity. We have a lot of respect for Vanguard as institutions, but from a financial advisory standpoint, we have people that worked at Vanguard that work for us. We have people that worked at Fidelity that work for us. I tell you what, it takes about a year or two for them to kind of get up to speed to where we're at from a planning standpoint. They're simply not allowed to do tax planning. They're simply not allowed to do the in-depth planning that we do. Now, this question may have been directly related to using them as a custodian and investing themselves. So even in regards to that, look, it's one of those things where if you can do it and you can do it successfully over time, more power to you. To do it properly, you're probably spending a whole lot of time, but in one way I get a little bit insulted by that and I know I don't, no offense, but what someone says when they come to me and they say, Troy, you know what, you guys are just too expensive, I'm just going to do this myself. For me, what they're actually saying is, they know more than Charles, they know more than Chris on the investment side, but they know more than me on the planning side. And look, we've dedicated our lives to this. So when things are going good, yes, it's a lot easier to manage money in the market because you throw it at the dartboard and you're going to make money. But when we start talking about the planning, the taxes, and integrating these various components, there's just a tremendous amount of value to be had. But what hurts my heart is there are so many, I don't want to say bad financial advisors out there, but there's salesmen, process system advisors, and it really devalues those of us in the industry that have dedicated our lives to becoming experts at what we do. And there's so many others that don't dedicate their lives to it, that do it for money, that do it for whatever reason, and we all kind of get lumped in and commingled. But there are amazingly talented people in the industry that have dedicated their lives to this. The problem for you, the consumer, is how do you find those people, right? And I think most of you have had bad experiences, and you say, you know what, it's safer to just kind of try to do this myself as opposed to actually, trust someone, because what if I make a mistake? Overconfidence, the same biases, because you're much more likely to make a mistake doing it yourself. But Charles, you seem like you have something to say.
I think it makes perfect sense. And we've been through, what I'm thinking is that we've been through a period of time in the market in which kind of doing it yourself, whether it was right or wrong, it kind of worked. It kind of worked for you. It worked well enough. Now, if you listen to Chris's YouTube and look at kind of what we're viewing going forward, this regime change that's happened in terms of global monetary policy, fiscal policies, creating a lot of volatility. Then you're going to find out as an individual, the struggles you have. It's no longer an easy decision. And you'll find out ultimately that there's a need. Thank goodness there's a need for what we do, because we have in fact dedicated our lives to doing it. And who else would get excited about dividend stocks and tax brackets, right? Yeah. So at the end of the day, we realize we're a bunch of nerds probably, but that's probably who you want on your team doing something like this.
Had a couple, real quick, guys, because we talked about this beforehand, and had a couple questions come in here. I want to talk about the JEPI and some of the exotic, I don't know if you call it functionality of the fund itself. So we're talking about a fund that has $20 billion. The current yield is around 11%. It's done well in 2021. It didn't do that bad at all in 2022, relatively speaking. But there's options involved. There's what we call exchange-linked notes, ELNs, I believe. Right. And guys, talk a little bit about the complexity, but also how the economic environment, it was a perfect timing for that fund to be launched, and how the economic environment maybe impacts it over the next 3, 4, 5 years.
Well, one of the things that attracts money to funds and the popularity is a fund will be run a certain way, and an economic environment will happen that allows that strategy to work exceedingly well. And then it gets 5 stars from Morningstar, which is a completely backward-looking rating. It will attract attention in the press, and you get a lot of flows into it, and you get a lot of chatter, a lot of excitement. People go pile into it. They don't really know what it does. And when those economic conditions change, that particular style of investing won't work. And nobody's going to tell you that. You're just going to realize it when you get your statement at some point in time. So it's a strategy that is interesting. They benchmark against the S&P 500, and then they sell options against all of those individual positions. And in periods in which volatility has been very high, you can sell that, and it generates excess return. Volatility has come down a lot now. Would my expectation be that it works well going forward? That's questionable at best. But the strategy is what the strategy is. It's not something for all seasons.
It's actually, so we get asked about individual mutual funds, individual structured products, all sorts of stuff a lot. And this was one of the few products that we've looked at that was like, hey, this is actually very interesting. It was when JP Morgan rolled it out, they pick individual stocks, so they're not an index-based stock picker. So they're equal weighted in the mutual fund, in the ETF, and then they're selling options on the S&P 500. So last year, when volatility in the S&P 500 spiked to 35, it was the perfect environment, because if you look back at last year, a equal weighted basket of stocks massively outperformed a market priced basket of stocks like the S&P 500, because the S&P 500 had FANG and the high-tech growth stocks in it, which weren't as heavily weighted in a equal weighted basket. So it worked fantastic. It's not to say it can't work again over time, but with lower volatility, do not expect that 11% yield to continue into the future. We had Jeff actually asked us a question kind of on this note. Do we invest in structured notes, private equities, or REITs? We do invest in REITs. They are a combination of public REITs, and then we do have a kind of a hybrid, which is a interval fund that invests both in private real estate and public real estate. So there isn't complete illiquidity as a lot of these private REITs. We do not invest in private REITs. We see people transfer those in a lot over time. And you can check in, but you can't check out in those things. They were sold a lot in 2016, and I think a lot of the brokerage firms promised 10% plus returns. We have not been doing that here at Oak Harvest on the investors' side. And then all these structured notes, I love looking at these things because I have an electrical engineering degree. I think I'm pretty math-oriented. I have a finance degree from a well-known Ivy League school, so I think I get math. And I have yet to find a structured note in 20 years plus of looking at these that I would ever put my money in, my dad's money in, any of my clients' money in, because they're ultimately a very expensive way to hedge something. And there's a lot cheaper ways to do it in the market. But man, they make great reading because usually
they're very creative.
They're
They're very
100,
creative.
150 pages prospectuses,
right.
and if you need an insomnia medicine to put you to sleep, they'll do it. So.
Yeah.
Well, it brings me to it reminds me of over the years, private investments. So one of the good things about being a financial advisor is I see all this stuff that everyone who ever comes to see us, what they buy. And I tell you what, when it comes to private investments, 50% of them, and this is just a rough estimation on my part, do really, really, really well. They do what they say they're supposed to do at least. But the other 50%, it's almost like I'm in a therapy session. Battery died, Eric. It's almost like I'm in a therapy session on these meetings because the client put in $400,000 because someone made a 10% commission on that private equity investment, and they've lost $300,000 of it, and their $100,000 that they still have left is locked up, and they can't get it.
Can't get it out.
People who have lost 100% of their money. So I guess my point is, if you have, if your document is more than yay big.
Yeah.
Right.
And there is risk of loss involved if you could potentially lose your money, it's something I probably would stay away from because you're dealing with people that are, just to be honest, a lot smarter than you, a lot more experienced. They, I'm not going to mention the name, but we had this conversation earlier about different institutions. They reach out to us and they try to get us to sell their things. They try to get us to represent their products or their strategies. And Charles was sharing, don't mention the name, but you want to share the story real quick, and then we'll close it out after this.
We had spent a tremendous amount of time at our predecessor firm and had created a very innovative, low-cost hedging strategy. And so we were new at it, so we said, well, let's go to a trusted partner, and they have a really great derivatives trading desk. And so we explained to them in extreme detail exactly what we're doing, what we're thinking, and they were very listening. Yes. Well, let us take a look at this. Well, 2 weeks later, that same firm comes out with this huge thought piece on, the advantages of using this particular strategy, and they institutionalized it and sell it across their entire platform. So we become, that only has to happen once to become a really big skeptic of how the ways of the world works. And these folks are great at putting together product that they believe seems appealing, but to Troy's point, if it comes with a set of papers behind it that's about 2 or 3 inches thick, just run away.
Yeah.
Most of the time, keeping it simple
Yeah.
is good for your investment terms. It's good for your anxiety levels. It's keeping it simple is something that helps people sleep at night.
Yeah.
And I'll kind of close it out here. So when you're in retirement, for a lot of our clients and for a lot of you watching this right now, it's not necessarily about the return on your money. It's about the return of your money. So is my money going to be in a place to where I know I'm not going to lose it all? Am I going to generate income so I can maintain the standard of living that I'm accustomed to? Am I going to pay less tax than I would otherwise if I employ this tax strategy or if I work with you? So there's a lot of complexity in the financial industry, but when it comes to retirement and when it comes to you, a lot of times simplicity is the most appropriate approach, and transparency and easy to understand. We don't have to make, for many of you, we don't have to make 25% per year. What we have to avoid is losing 50% per year. So when we look at standard, tried and true practices of diversification, understanding the impact of economic conditions on certain sectors and maybe being able to tilt the portfolio a little bit to take advantage of that, but with a focus on risk management. We look at generating multiple streams of income from multiple different places. We look at reducing taxes. We look at something as simple, step 5 of our retirement success plan is meeting with your attorney or recommending an attorney. We have attorneys all across the country that we work with to help you have an estate plan. One of the biggest things most people overlook is when your money passes on, and let's say your son or daughter gets a divorce, is your daughter's future ex-husband going to get half of your retirement? Well, without a plan for that, yes, most likely 50% of you is the statistic. Okay, that's our job. Okay, when we're talking about the retirement success plan, we want to see you spend money that allows you to enjoy your standard of living, keep up with inflation, but more importantly, reduce taxes, keep it in the family, make sure it passes efficiently, optimize. And it all comes down to a relationship where you have an intentional focus and dedication to these core tenets that allow you to have value and get ahead. So that's what we do with these YouTube videos, and that's why we have them. Hopefully those of you that are self-directors, you've learned something from this. You can apply it to your own personal situation. If you have an advisor and maybe you're not happy, feel free to reach out to us. And if you are a client, thank you very, very much for trusting us with your money. It means the world to us. We look forward to seeing you next month in the live stream, and thank you very much for tuning in.